Point number 5, if there are deferred profits, right, what do we need to do? What do we need to do? So the idea is that if the payment is completed by the time the project is delivered, maybe the project is delivered in 3 years and the payment also is completed within 3 years, then we can use the percentage of completion method. That's fine. But since it is a mode of financing, so at times it happens that although the project is delivered in 3 years, but the payment actually is collected in 7 years. Some payment in the initial 3 years and then remaining payment in maybe the remaining 4 years. So if we use the percentage of completion method, then what happens is that the entire profit will be recorded in the first 3 years, but the payment is to be received in the next 4 years as well. So what should we do? So here the accounting standard actually comes into play. Okay, so in that particular case, the standard actually stipulates that the difference between the total price paid over time and the agreed cash price. So first of all, if this is a situation that the contract period, the delivery period of the al-masnu, the commodity which has to be manufactured, the project which has to be manufactured, is different from the payment period, then first of all we have to come up with what should have been the cash price of the contract and what is the actual price of the contracts. So assume that there is an Istisna contract for PKR 5 million with the estimated cost of 3 million. So the total profit is expected to be 2 million. Delivery of the contract is in 3 years. So in 3 years the contract will be manufactured and delivered by Al-Sani, the bank, but the payment will be collected in a total of 5 years. Right from the very start, the payment will be collected in 5 years. So now we have to come up with that the 5 million price is actually for a period of 5 years, right? What should have been the price, the cash price, if the party, the buyer, the client, if we would have made the contract that the buyer would have paid in 3 years, then what should have been the price? So that's the cash price. And the FA says this is the something which is agreed upon the buyer and the seller. So let's estimate that the cash price is $3.8 million or rupees. It means that if the terms of the contract were such that the client will pay in 3 years, then when we wouldn't have charged 5 million, we would have just charged 3.8 million and the cost would have been 3 million. So the cash profit, it means the profit which would have recognized by the time we would have delivered the project would be 0.8 million, which is 3.8 minus 8. It means the extra 1.2 million which we are charging is actually we are charging because we are extending the credit for 2 more years. Now this means that the total 0.8 million of the profit is actually profit recognized on percentage of completion method, whereas the remaining 1.2 million of the profit has to be recognized, right, because there is a deference of payment. So this will be recognized in last 2 years after the completion takes place. So for example, from the 4th year and the 5th year. So this is the way the standard stipulates that you have to, if this is the case, that the payments will follow the delivery of the asset under construction, which is al-masnu, then how do we split the profits in the payment period and in the manufactured period? Because if we apply the percentage of completion method onto the entire amount 5 million, then this will be recorded in the 3rd year completely, and in the 4th year or 5th year some money is still to be received and there will be no profit. But since it is a financing transactions effectively, so it has to go beyond that. So then we need to do this kind of thing, that we have to come up with a cash price, and the profit up to the cash price is to be recorded under the percentage of completion method, and the profit beyond the cash price has to be recorded under the deference payment method. So for this also there are 2 methods. The one method is the suggested method, preferred method. It says that proportionate allocation over future financial periods of credit regardless of cash receipt. Now in the next 2 years, maybe in year 1 we receive just 100,000 cash, and in year 2 we receive 1.1 million cash because 1.2 million is outstanding, right? So the standard says that we have to divide the profit proportionately regardless of the cash flow. 50% of the profit, that is 0.6 million in year 1, that is year 4, and 0.6 million in year 5. But the second method, which requires Sharia approval, is that recognized only as and when each cash installment is actually received. It means this is a sort of a time value of money related model. Point number 6, if there are early settlements, right, if the client pays early, the bank may waive part of its profits. So in the same example, when the credit period was 5 years, say the bank pays all the amount in 4 years, then we can waive the part of our profit, right? The bank may. So this is an option. The client cannot demand it, but the bank can do this. The waived amount is deducted simultaneously from both accounts or reimbursement directly in cash. So apparently against the spirit of Islamic finance, TVM based payments, but again, since there is a option, right, non-net obligation, so this is something which is provided in the standard. Point number 7, if there are change orders which were unforeseen, right, approval modification to specification, quantities or design added to Istisna's revenue and cost. For example, we were manufacturing a diesel turbine, a diesel generator, for example, and eventually, because of the war situation, the client says that okay, also include the solar power panel in the generator. And these are the modifications. So for the modifications, we have to accommodate, mutually agree upon the contract, the specifications and the change in the contract price, and accommodate that into our calculations for percentage of completion, and accordingly everything recorded after modification will take into account those changes. And if there are some additional claims, that is some claims which are either because of delays by the Al-Masnu, the Masnu did not provide the specifications in times, there are some errors in communication by them, there are some client cost issues caused by the client, and we have suffered some cost because of that. So these are the additional claims. We cannot charge profit for additional claims as per the standard. What we can do, we can charge if we have suffered some out-of-pocket actual expenses, the bank. So a legal basis supported by verified proof, we should have proof that we have suffered some losses, some costs because of the delays or because of the additional claims. They were unforeseeable, caused by circumstances unknown at contract date, not due to the bank's negligence, right? It was not something that bank should have arranged, but bank didn't arrange, right? And they are measurable. So these are the 3 conditions. If they are there, then the additional claims can be accommodated in the cost as well as the revenue. So there will be no profit element over here. In the change order, there can be a profit element, right? Point number 8, if there is a loss